Today, we're doing something fun. We're taking a modern-day financial giant, BlackRock, and we're going to put it under the microscope. But not just any microscope. We're going to use the battle-tested, no-nonsense rules of one of the greatest investors ever, Peter Lynch, to figure out if this titan is actually a smart buy right now. So let's get into it.
All right, welcome back, everyone. It's great to have you here. We're going to jump right into the meat of it, straight to the facts and the figures. First off, let's just get our heads around the sheer size of what we're talking about. BlackRock has nearly $14 trillion of other people's money under its control. That is a number so big, it almost doesn't feel real. They are, without a doubt, an absolute fortress in the world of finance.
But you know, even the most impressive fortress can be a terrible investment if you pay way too much to get inside the walls. So that brings us to the big question for this whole explainer. Is BlackRock a buy today, according to the rules of Peter Lynch? Let's start digging. First things first, we've got to know exactly what we're looking at. What does BlackRock actually do to be so successful?
You know, Peter Lynch always said you should be able to explain what a company does in simple terms. Well, with BlackRock, it's actually pretty easy. Think of them as the giant toll booth of modern finance. Money is always moving, and they get a little piece of it. They collect these tiny, passive tolls from their massive iShares ETFs. They charge bigger fees for their active management services, and they even rent out their super powerful risk management software, Aladdin. It's a simple, powerful, and crazy profitable business model.
So in the world of Peter Lynch, where does a company like this fit? Well, it's a classic Stalwart. These are the big, boring, established giants. Think Coca-Cola. They're not going to give you 100x returns, but you can count on them to chug along, growing their earnings by a nice steady 10 to 15% a year. BlackRock fits that description to a T. Okay, now that we know what BlackRock is, let's get to the good stuff. Let's run it through the Peter Lynch checklist. This is where the story gets really interesting. And whoa, right out of the gate we hit a major red flag. Lynch's #1 rule was so simple. A company's price-to-earnings ratio should be about the same as its growth rate. But look at BlackRock. Its earnings are growing around 11%, but its PE ratio is way up at 28. That gives us what's called a PEG ratio of about 1.5. Basically, it means we're paying a 50% premium for that growth. For Lynch, a fair price would be a PE of 11, not 28. That's a huge difference.
So let's look at the full scorecard here. The PEG ratio, that's a clear fail, as we just saw. The dividend? Okay, that's a big pass. It's super reliable and has been growing for 17 years straight. But then, institutional ownership gets a big fail. Lynch wanted to find companies before Wall Street did. With over 80% of shares owned by institutions, BlackRock is the opposite of a hidden gem. And finally, the balance sheet, yep, rock solid. That's a pass. So it's a mixed bag, but those two fails are pretty major ones.
Let's really drill down on that PEG ratio failure, because for a guy like Peter Lynch, valuation was everything. This is really the heart of the problem. Now, I know exactly what some of you are thinking. Come on, this is BlackRock. It's the king of the castle. It has a massive moat. Isn't it worth paying a little extra for a best-in-class company? And you know what? That is a totally fair question. But it's a question that Peter Lynch had a very clear and very firm answer for. This quote says it all. This was his entire philosophy. Lynch was a bargain hunter. He believed his advantage came from finding great companies that nobody else was looking at yet. He would have said, why would I pay a 50% premium for BlackRock, a company everyone already knows and loves, when there are thousands of other rocks I haven't looked under yet? A great company at a bad price is still a bad investment. And here's the real danger when you pay up like that. You're pricing in absolute perfection. You're betting that nothing goes wrong. But what happens if BlackRock's growth slows down just a little bit, from 11% to maybe 8%? The stock doesn't just go flat. It can get absolutely crushed as the market says, whoa, we're not paying that high price anymore. That's called multiple contraction, and it's how you can lose a lot of money on a really good company. It's a risk Lynch just wasn't willing to take. So you might still be thinking, okay, but it's a Stalwart with a great dividend. Surely Lynch would cut it some slack for that. Well, lucky for us, he actually gave us a formula to test that exact idea. So Lynch came up with this special formula just for Stalwarts to factor in their dividends. It's pretty simple. You take the growth rate, you add the dividend yield, and then you divide the whole thing by the PE ratio. And for it to be a good investment, he wanted that final number to be 1.5 or even higher. So let's do the math for BlackRock. We take its 11% growth, add the 2.18% dividend, and divide by that PE of 28. The final result? 0.47. Oof, that is not even in the same zip code as 1.5. This fails the test, spectacularly.
So after running BlackRock through the entire Peter Lynch gauntlet, what's the bottom line? What's the final call?
The verdict is pretty clear. BlackRock is an incredible, high-quality, world-dominating stalwart. No question about it. But at today's price, it's a premium-priced stalwart. You are paying up big time for that quality. And that's a game Peter Lynch just wouldn't play.
So what does this all mean for you? Well, if you already own BlackRock stock, the Lynch playbook would probably say just to hold on. Let this great company keep compounding your money and just collect that solid, growing dividend. But if you're on the sidelines with cash, looking to buy today, the message is pretty clear. Wait for a better price. This is not a buy signal.
And that really brings us to the big question you have to ask yourself about your own investing style. Are you the kind of investor who is happy to pay a premium for a dominant wide-moat company like BlackRock? Or are you more like Peter Lynch, someone who gets a thrill from turning over rocks and looking for that next great company that Wall Street has completely overlooked? There's no right or wrong answer, but you've got to know which game you're playing.
Hey, if you enjoyed this breakdown and got something out of it, do me a huge favor and hit that like button, and make sure you're subscribed for more deep dives just like this one. Thanks for watching.